you can understand liquidity. So, first of all, what is liquidity? Okay, what is liquidity? You should ask yourself that question. Okay, liquidity is simply, okay, the remaining orders at certain levels, or um, I'm looking for the English words to give you the exact definition, but let me show you in the graphic and then I will complete, okay? So first of all, when you see here, this line that I'm marking here, this, it's called liquidity. Why? Because at some point, retail traders, we are retail traders too, but people who trade with the retail mindset and retail strategies, here they have taken a trade. Okay, these first are very aggressive, and here when you take at this level, you expect to see a break of structure. Let me show you the break of structure is here, right? Some other traders took a sell here, okay, and then they put the stop loss above this swing high here and target this low here, okay. Some other traders like smart money or us, they're waiting for price to come back inside this fair value gap here. And from this fair value gap, they take another trade here. So wait now. I'm going to zoom out. I want your eyes to spot all the highs and all the lows that you can see here. And then I will explain to you guys. I want you to see everything. So I'm going to mark the one that I see, okay? High, low, high, low, high. I'm doing it reverse. Low, high, low, high, low, low, high, low, high, low. Do you see these points? Yeah. So now we we are we are we are talking about liquidity, okay? Liquidity is all the orders that are standing here in this place, in this place, in this place, in this place, okay? But just imagine people took position there and they have their reasons. The first one, okay? The first one, it's at swing points or pivot point. The second one is at equal levels. Third one is at break of structure. This is internal. Okay. Where do you find liquidity again? Time-based level or time-based levels. Why do I say that? If you look on the weekly time frame or the monthly time frame or the daily time frame, the highest point of the monthly and the highest point of the daily, there are liquidity remaining there. Okay. That that point was at some point, if I can say that, was a stop loss for someone. Okay. I'm going to grab this, take this text, erase it first, and then bring you to another time frame. Let's go on the weekly time frame. If you go on the weekly time frame here, what do you see on the weekly time frame? You see weekly candles with weeks and bodies. You see this high, this high, this high, this low, this low. These are liquidity point. You can target them. Now, let me explain to you why we target liquidity. This is not just a basic class about liquidity. I'm saying this because I know you already know the indicator we use at Buzz. We have sell side and buy side liquidity, but I'm explaining to you the core and the origin of liquidity. So here, liquidity comes from the remaining orders at some point where price is looking to come back to get them. Why? Because the market maker, they need liquidity to move price. They cannot just move price by themselves because they move billions and billions of dollars. So they need to find a counterpart. If you want to sell, you should look for someone who want to buy. Okay? If I have $1 million to sell in France, I should find someone with $1 million of value in euro to buy. And that's why sometimes they want to catch liquidity on the market. They will go look for buyers and sellers at certain point, take their orders, and then they can now launch their own orders. But at some levels, they will leave orders. What do I mean by that? Look at here. When you have a buyer who took position here at this level and targeted this high here, okay? He made some money for some days, okay? Here. He made some money and then price returned. Even you right now in this USD CHF trade that we have, you are making money right now. Let me show you. In this trade that we took yesterday, even you right now, you are making money, right? You are positive. But at some point, you were negative. Okay? So right now, you are positive because the price is going in your direction. If you don't close your trade at the right time, and at some point our trade doesn't reach this level and then comes back here, then you are negative. But at this level, if you look here, you know you're positive. The problem is, at what time did you come back to look at the price? I'm saying this why? Because every session, every time frame, and every day can be different according to what the market objectives are. But you should remember where are the most buyers and the most sellers. And if you want to trade in the direction of the institutions, you should go look for liquidity. Okay? So I'm going to explain to you how I did this. Let's go to USD now. I'm going to USD I'm going back here. Let me go back again and again until we reach all that. Okay, here. So on the daily time frame, for example, when you see a candle break structure like here, you expect a sell, okay? And you are not wrong. But this sell means there are people, okay, that put their position here. At some point, if I come here, they will be obliged to sell, to close their trade, to get out of the trade, okay? They buy back their own positions with either negative result or break even. But who took that money? The institutions, okay? So it's their advantage to come and look for liquidity that we put on the market as retail traders. Now, you can target liquidity as the institution does, but you should always think at what level you have liquidity. That's why I have to remind you this. Liquidity is the remaining order that you can find at certain level. At swing points, equal lows and equal highs, equal levels, at break of structures, and then time-based levels. If you keep that in mind, now let's go put that in practice. Okay? You can come here and observe I need to find another broker. Let's take Euro USD. Okay, let's change for just for the sake of the example. Let's take this one. Okay, Euro USD here. I'm going to go on a lower time frame like 1 hour, and we are going to understand what price did and why. Okay, I'm going to explain to you. We have break of structure. Okay, we have swing highs and swing lows. Let me show you here. Here we have a low, right? We have a high, then we have a break of structure. After this break of structure, price came, created a high. This high got broken, and before that break of structure, we had another low created. It left liquidity here. Why? Because everyone who was waiting for price to break this level and then buy here and target it at 2R or 1R like this, at some point, okay, I will put it back, no problem. It was on, wait, please. Please, everyone take notes so I can leave these charts alone. It was a wonder, right? Okay, this is it. Just take these notes quickly so I can leave this chart and then go back to Euro USD. Okay. So now let's go back to Euro USD where we somewhere here. Okay. Okay. I was explaining to you here. After this break of structure, you took a buy. Okay. Nothing of this happened yet. Let's do this like this. Okay. You came here, you took a trade, you targeted up here. Now, how do you find liquidity? Remember, equal highs and equal lows. When we mark liquidity on the chart, we expect for price to return to take that level. So liquidity for us has two main roles. The first one is where we target, okay? And also liquidity can tell us what swing high or swing low is protected. Okay, imagine we continue here, huh? Okay? Wait, I have to show you here first. We have this swing high and this swing low. Let me take the bar. Okay, good. Look, we have this swing high here. What happened after this break of structure? Price took out these highs. We are bullish. And from here, you can see how price created a low and then a high, returned inside. Okay. Returned inside, I mean what? Premium and discount, right? It came back inside this zone. Okay. And after doing that, what price did was going back up. So a smart money trader would take this trade, he would be right, but you should always know where you're getting out of the trade because this is your liquidity level that you're targeting. Your stop loss should be here. Why? Because when price will take out this liquidity zone, now we will form a protected high. Let me show you here. We continue like this. Then when we take out this liquidity level and then we break this level back inside, this is now a protected high. What does that mean? It means price will come back here only after taking another liquidity zone in the opposite direction. We have one here, we have one here, and we have one here. Whatever you do, who is drawing on my screen? Check your screens, guys. Stop drawing on my screen. Moving stop loss to break even. Yeah, I will show it. So here, please check your screens. Someone who has the phone or tablet has drawn on my screen. Okay. So here you have, this is now a protected high. Okay. When you have a protected high like this, you know you should target the opposite direction. And here is the zone of confirmation. Whatever happens, you will never buy against this. You will not trade against this. I mean, when this confirms that we have a sell, a strong high is formed after taking out another liquidity. And you can see this liquidity zone is important. Why? Because it's a daily high. You all know that my blue lines here, my vertical lines, are level that I mark as the opening of the day. So this is a daily high, and a daily high has been taken out with this candle, and price start reversing. Okay, now what I'm trying to do here is to show you that after the reverse, if I have a break to the downside, okay, here you see, if I close this, now this is confirmed to be a strong high. This strong high, it's protected. And sometime if you go check on GBP USD, you will find a divergence here. So GBP will be like this, GBP USD will be like this, and Euro USD is like this. Okay, so you know this is a protected high. After breaking this, the line that's created at this break of structure, it's called a change in direction or change in the state of delivery. This line is where you could enter later, protect your trade here, and you can target the next liquidity zones that we marked here before. We had 1, 2, 3, maybe this one or maybe this one. And thus, when you see price play out like this, you will see how price will stay here, but you can have your trade later. This is what happened on our USD CHF today. And I need to show you guys. This is how you use your level of liquidity as target. You know first that you have a strong high. You target the opposite side. After the break of structure, you have a confirmation, and then you watch price play out in the direction of your trade. Okay. I don't remember if this one worked out, but yeah. Let's look for another example. This is one of the H1. Need to stop. Something is running. Who draw on my screen, guys? Now here, second, look. I will tell you why this one did not work out, and I will show you the opposite side of it. Now look at this daily low here. You have this daily low here. You had a swing taking out this daily low, high, and the highest point here, the higher level of this week, because that was Monday. You had another liquidity zone here, okay? Showing you two examples. One did not work, one worked. And I will tell you why, so you can keep that in mind. Here is the same situation, right? We had premium and discount. All the sellers came in this trade around here. They are looking for sales because of the breakouts. Some others are selling here because they want to continue lower, okay? All this did not happen yet. As soon as you see time-based level taken out, like this daily level here, now you know you should target the liquidity on the other side. And that's what happened here. After the change in the state of delivery, because this is the break that's confirmed the direction. change in the state of delivery. This is the trade that confirmed the direction. After the sweep that we had here, as soon as price close around here on the lower time frame, you can come and look for a trade and you target the next liquidity here. Now, why did the second one work and not the first one? Because you always have to consider the higher time frame direction. Because the market will trap you against the main bias, so you can take trade, but always remember the higher time frame direction. And how do you find the higher time frame but direction? I told you, it was like the second lesson we had in this course program that we are having. It was as soon as the market close in the breakout on the daily time frame, next day we expect the same movement to continue. Look at here. We close in the breakout, we bought, this was our direction. So whatever happened in this candle on the lower time frame, because it's a daily candle, showing you that you should sell, you should see it as inducement. That's what they call inducement. Inducement is a confluence that will give you the wrong direction to induce you to take a trade in the opposite direction. So you should know what is the main direction, which is your daily bias, and you should trade accordingly. So whatever direction you see on a daily is defined by the candle theory. After you close your trade, you confirm the direction by the way the next candle will form. Look at this. When you have a break here, you continue higher. When you had this one reversing, the move is continuing higher. This was a pullback. So inside here, there was sweep of liquidity and then you continue higher. Always consider the higher time frame bias. Okay, guys? So liquidity is when orders remain at a level, you should come and target the liquidity later. Liquidity can also be the signal that an inducement happened, like here. I need to go back. I'm trying to take this one as an example. On Euro USD, you can see it here. When you have, this is a daily time frame, right? So as we know, price has closed in a breakout. We had a breakout at this level. We had a sweep before. So the next day, we expect to see price continue higher. But what did price do the day after? Let's go now and discover together. You see, we had this. We had a fair value gap. We had a fair value gap. And look at the next day. What price did the next day? Price came. Okay. So someone else say this. Okay, we see this liquidity grab here. That's what Mr. Who? This is what Mr. Coffee said. Okay. He said, when price take out these highs, they told us that after he break the structure, we should expect to sell. Okay, you're right, no problem. But look what happened after the break of the series of candle that came to create this sweep, because this is a sweep of liquidity. This is the liquidity. This is the sweep of liquidity. Don't confuse the two. Don't think that this is liquidity. No, this is the swing that took out liquidity. So this is the protected high. But like I told you, liquidity can show us where are the resting orders, okay? They can serve as target, and they can also serve as inducement level that we know price tried to tell us something that is not real when it's opposed to the daily bias. We said the daily bias was going higher, price induced buyers. So now we are confused. Okay, price was supposed to continue higher, but now it's induced buyers, so we're supposed to sell. Okay, let's do it. Now this level here became the change in the state of delivery or change of direction, and someone could have taken a sell here, protect right above this, and target this fair value gap. Let's see if it touches. You see, the position is correct. But look what happened in the New York session. We had now the real inducement created during the New York session. Okay? Now, who's targeted? The guy who sold here is our target. At this level, we remember where we are. We are inside of a fair value gap. You see where we are. We are inside of a fair value gap. So this was internal range liquidity because it's internal. So inside your fair value gap on a lower time frame, you should see an inducement that confirmed that these sellers have been trapped. And now the sellers, okay, that took the trade here, now their trade is turning against them. And what happening here is, look, price created now a new change in the state of delivery. Okay? A new change in direction. And from here, we have a buy now. Okay? In the direction of the trend. Remember the direction? It was buying. And when you see that, let me go back. When you see that, you know you are right because the direction you are taking is the same as the daily bias. I'm explaining this because sometimes you will see inducement in the opposite direction and you think you should take a sell. Always remember the direction of your trend. Okay? So now you know liquidity, where we find liquidities, equal highs and equal lows. Okay? And when you have a trade like this, just to explain the question that you asked earlier, to move your stop loss to break even, it's what? When you had your stop loss here, and this is your entry point, if price comes and hit you here, you have $0. Okay? When you have $0 of benefits or profits or nothing moved in your account, when you get out here, it's called break even. Okay? I hope everyone knows that. So here is our stop loss. To move your stop loss to break even means after the trade has gone positive, you take your stop loss and you move it to the 0 point. So you cannot lose anymore. Even if price comes back to your entry point, you will hit the $0 profit, but your account will have no loss. That's what I mean by putting your stop loss to break even. Okay? Is there any question? Is there any other question, please?
Could you just show it one more time?
Yeah.
Oh, thank you. Okay.
Okay. When you have a position that is running, right?
Okay.
You cannot put a position that is negative at break even.
Right.
You can only put a position that is positive. Okay? Let me take this example here. I'll take this all off. Okay, let's take this all off. Just imagine you took a sell here at this point, at that day. You were wrong about the direction, but no problem. You took a sell here, you protected your trade here, and you targeted low a lower price here. Yeah. Okay. So now you don't know what price will do, right? You are here, price is moving in your favor. You have the trade is positive, is going. So we imagine this is the green zone, right? The green and the red. So now price
Mhm.
is going down, down, and then at some point it hit the TP1. Imagine TP1 was here, okay? This was TP1, okay? After TP1, we know now, I said in the comment or the updates, I told you guys when you're TP1, take partials and put your stop loss to break even. You will come and take your stop loss value. It's a price. The price is somewhere here. You can see it. You will go now and take the price at your entry level. So your stop loss will move from here to here. Okay?
Oh,
This is
okay.
how
I got
you
it. Okay.
put your trade to
Okay.
break even. So whatever
Okay.
price does, you will not lose. Even if it comes back to your entry, you have $0 of loss. Okay, guys?
Right. Okay.
Okay, thank you everyone.
I got it.
Thank you
Thank you.
for being present again. The call will end up in like 10 seconds. Thank you everyone. I hope you understood what we discussed here. Next time we will talk about all of it to put together and we will share a live session. Okay? Thank you again, everyone. Goodbye and God bless you all. Yeah, just text me and I will send you the link. Thank you, everyone.